Well, good morning, friends. So, the topic of the day is risk based supervision model. Risk based supervision model. Let's try to understand the Insurance Regulatory and Development Authority of India issued a circular to all the insurance companies of India in 2018 with the title Moving Towards Risk-Based Supervision of the Insurance Sector. In 2018 it was circulated. That time the IRDI said that they are in the process of adopting risk-based supervisory framework. In short, RBSF, risk-based supervisory framework for holistic supervision of insurance sector in India. So the authority would be developing an overall plan for moving towards risk-based supervision to undertake a review of the current regulatory and supervisory regime and prepare an appropriate framework for holistic supervision, duly incorporating risk assessment mechanism into insurance supervision. Actually, at present the authority is primarily focusing on compliance-based approach for supervision. Over a period of 2 decades, the number of entities to be supervised have increased manifold. So to supervise on compliance approach would need the same yardstick to be applied to all regulated entities regardless of its size, business model and nature of significant activities. So instead, under risk-based supervision, each regulated entity will be assessed based on its risk profile and the overall risk it carries. So this will enable the authority to focus more on entities posing higher risk relative to others. So to that extent, the authority will also be in a position to use its resources efficiently and achieve effective supervision. Now, the risk-based supervision framework would consider various risks the insurers pose to themselves and to the financial system at large. So the risk profile of each entity would determine the supervisory action plan comprising off-site monitoring, on-site inspections and a structured meeting with the entities in conjunction with the specific supervisory action plan. So assessment of risk in a typical risk-based supervision would include identification of significant activities based on certain criteria, that is, identifying the inherent risk, examining the control mechanism built around the risk, leading to an understanding of the net risk involved in each significant activity. So aggregation of net risk for different significant activities would provide an aggregate net risk. So the additional support available for the entities in the form of capital, liquidity and earnings would be suitably adjusted against the aggregate net risk to reflect the overall risk rating for the entity. So the benefits of adopting an risk-based framework. Adopting a risk-based framework for insurance supervision could be summarized as follows. That is, the first one is a structured approach to help assess various risks, both internal to the entity and external to the environment. A structured approach to help assess various risks, both internal to the entity and external environment. Then risk-based supervision is forward-looking and outcome-based with the due focus on the responsibility of the board and senior management of the entities to ensure financial soundness. And lastly, it facilitates identification of various risks relating to market conduct and prudential aspects at an early stage so that timely regulatory intervention is possible depending upon the overall risk profile of the entity. So the recent Financial Sector Assessment Program report of 2017, the International Monetary Fund and World Bank recommendations that the authority to move towards a risk-based supervisory approach. Insurance core principle of IAIS also requires supervisors to adopt risk-based approach to supervision that uses both off-site monitoring and on-site inspection to examine the business of each insurer, evaluate its condition, risk profile, and quality and effectiveness of corporate governance. So the recent times, the international financial spectrum has witnessed trends towards globalization and consolidation. The stability of financial system has become a challenge for the regulators globally. In India too, the insurance sector has also reached a stage of development over the past 2 decades to require a risk-based supervisory approach. So the process of moving towards risk-based supervisory, certain changes are envisaged in the functioning of the regulated entities, and major changes would include the regulated entities need to have well-defined standards of governance and well-documented policies, procedures and practices in place to outline the responsibilities and accountability more clearly. Then to revisit the organizational structure to align with the requirement of risk-based supervision and review of risk management culture, adopting risk-based internal audit, improved IT and MIS to capture and report various elements required for risk assessments, and building compliance units to take prompt corrective actions suggested by the regulator from time to time as part of the supervisory action plans. And the last one is the review of all skill sets, extensive training, redeployment of staff, talent retention, etc., as may be necessary to move towards risk assessment in place of mere compliance. That means it is intended to roll out the risk-based supervisory process in phased manner, starting with insurers and then intermediaries, after running a pilot project on select entities to test the efficacy and efficiency of the implementation and to identify possible gaps, if any. In the process, there would be consultation with the industry players on an ongoing basis at different stages of development and implementation process. So within IRDAI, an implementation committee has been formed to suggest the implementation approach for risk-based supervisory and to achieve a smooth transition. So given the backdrop, the insurers and intermediaries may initiate steps to lay greater focus on identification of risk in each activity they undertake and to build framework that enables internal assessment of such risks and corresponding control mechanism to mitigate such risk within their organization culture. So the authority would keep the industry updated on an ongoing basis on the phase of development of risk-based supervisory and suitably involve the industry as and when required. So the country's insurance regulator may consider implementing a risk-based supervisory model similar to that in the banking sector, which will establish principles of managing operational, market and government risk in the insurance industry. So, the IRDAI is in the process in recent years, such as enhancing commercial and operational flexibility through management expenses, regulations, raising subdebt limits, and introducing the Bima Trinity, that is Bima Bistar, Bima Vahak, and Bima Sugam. Additionally, other initiatives by the insurance regulators like the establishment of a state level insurance committee, increased payout for early policy surrenders, and relaxed regulations governing the opening of new branches by insurance companies. So these regulations would increase ease of doing business, encourage development of long-term or longer-term products, and improve persistence, thereby creating value for customers. See, the low insurance penetration in the country is a matter of concerns. So expansion into Tier 2 and Tier 3 cities by the insurance companies will drive growth. The life insurance penetration in the country stands 3% in 23, while non-insurance penetration stands 1%. And India's overall insurance penetration reduced to 4% in 23 from 4.2% in 22. So, this has contributed significantly to making India the fastest growing major economy. But the penetration has to be increased, because when the insurance penetration is not increased, that means the insurance volume is increasing, but it is not expanding. The reach is not to all, while the target of the IRDAI is insurance for all by 2047. So insurance regulator will roll out the first phase of a pilot for the risk-based supervision framework for the insurance sector in India in this year and very soon. Because in order to promote a principle-based regulatory regime, foster ease of doing business and encourage proactive risk identification and management, IRDAI has been working toward developing and implementing the risk-based supervision framework. So for this purpose, the regulator has collaborated with Toronto Center, which is a not-for-profit organization working with mission of promoting strong supervision in order to enhance the financial stability, crisis preparedness, and customer protection. The risk-based supervision is a shift towards adopting a global best practices for supervision, which focuses on proportionality, materiality, and relies on the holistic analysis of the activities of regulated entities from risk perspective in order to ensure robust development and smooth implementation of risk-based supervision. IRDAI has been engaging with various stakeholders over the past few months. So, IRDAI is giving a serious thought in order to ensure a robust development and smooth implementation of RBS and engaging with various stakeholders to implement it very soon. Thank you very much.